welcome to the Compass. As always, I'm Derek Macpherson, Executive Chairman of Olive Resource Capital, and with me is Sam Pelaez, President, CEO, and CIO of Olive. We're recording today on Wednesday, April 9th at 10:22 a.m. as the recording is starting, and I'm highlighting that because what we may talk about may be stale by the time this comes out. With everything that's been happening in markets. Unless you're at Ostrich have had your head in the sand the last little while, everyone's aware of the tariffs and then the market fallout that's come with that. And I think it's been very, I guess from a market perspective, it's certainly been created a lot of volatility in it. But I think interestingly, despite sort of a race to liquidity, which we often see in these volatile times, gold's really held up.
Yeah, I mean, if you go back to our disclosure and everything we've discussed in that last little bit, even in November when we were recording some of these episodes, we were talking about the expectation for 2025 to be a very volatile year. We were expecting it to be a positive year, but quite volatile, and I think that's materializing so far. And at the risk of going sort of counter the trend of worry, other than a completely trending market, upward trending market, the next best market you can have is a volatile market, because obviously that opens up opportunities. And we're surely going to start seeing some of those coming up here shortly as a consequence of this market drawdown. General broader market drawdown.
You were a fund manager for a long time. You're sitting, I guess take yourself back to when you're just running more of a traditional mutual fund. And what happens on, last week on Thursday, the tariff news comes out, and what do you wake up to in the morning, and then how have you got to position yourself at that moment?
Yeah. So most mutual funds are T+1 or T+2, much like stocks. So typically what you would have got on the Friday, on the Thursday at 4:00 when the market closes, it's a sort of like a message from a transfer agent telling you how much money you have to have ready for the next day to be withdrawn for redemptions. It's the most brutal part of being a fund manager is market drawdowns are trigger significant market liquidations from fund advisors, retail clients, and such that have positions in your fund. And unfortunately, what that results in is essentially forced selling of stock. And this is not just for, say, oil and gas and copper that have seen market drawdowns. This is pretty broadly generalized across the entire market. It's the hardest thing to manage as a fund manager is the liquidity outflows at the bottom or near the bottom. When you're forced to sell the things, you start selling the things that you don't have all the conviction in. But typically, it doesn't stop until you have to start tapping into your conviction names.
Well, and the reality is that in a drawdown, you have to sell everything with a bid, right? If you're a larger fund and the thing that's had a bid over the last couple of days is gold, and so you've been selling. People that would have been selling their gold, right? There's this. It's a pure liquidity drawdown initially. That's what the initial move is. And I think we've seen that. I mean, markets seem to have stabilized a little bit. But again, it's 10:26, so it could be volatile again from here. But that initial drawdown, it's sort of, as you said, it's conviction and high conviction and low conviction names, but everything goes, right? It's
absolutely
you've got to get yourself into a position to fund those redemptions. And so I think that in and of itself is what, as you talked about, right, at the beginning, that's what creates the opportunity.
Absolutely. Traders make the most money when there's volatility.
Right.
And if you're a good investor, you also need to try to be a good trader to get in and out of positions. So this could be an opportunity to make a great 2025 if you catch it at the right time, obviously, and you buy the right things. So I guess in this episode, let's cover this whole tariffs scramble a little bit, and then try to communicate what we are thinking and how we're positioning our investments, what we're doing or not doing in light of this tremendous volatility.
Yeah, so I think I mean the tariffs have been announced. We've seen the massive drawdown. I mean, we're 5 days into it, 5 trading days into it now. We seem to have, like I said, it's 10:27 now, so markets seem to have stabilized a little bit. Still volatile. Still going to see lots of volatility from here, I think, as the news comes out, as President Trump puts out, official communications via Truth Social. We're going to see what kind of happens from here, right? We're going to see a lot of volatility created by that. But I guess, for lack of a better description, kind of what do you, I guess kind of comes back to what do we think is going to cause those material moves to change, right? I mean, there's lots of people talking about increased probability of a recession, but we don't know that that's happening yet, right? We haven't seen any data to confirm that. Obviously, there was big inventory moves into the U.S. ahead of these tariffs, ahead of Liberation Day. So there might be a delayed reaction as far as seeing it, price increases come through or margins collapse or vice versa for producers. But I guess, we were talking about this offline, but what are the kind of the things that we think, what are the big things that are going to change, potentially change the direction of the market, or, either cause a further downturn or cause, put the bottom in?
Let's turn it backwards and say, what is the real objective of this tariffs? It's clearly not to balance out global trade. That's clearly not what it is. Case in point is Brazil has one of the largest import tariffs for U.S. goods. They didn't get any additional tariffs, just the baseline 10%. So clearly, it's not a case of trade. This is more a case of deficits and financing, right? The next big thing that we're going to see in Washington is the negotiations over the budget for 2025, which, by the way, there's no budget for 2025. We're still operating in a continuation of the 2024 budget. And when Trump tried to do it about a month ago, Congress didn't approve it. They approved the continuation. But with the debt ceiling looming, et cetera, this is more about government finances and the Treasury and the Fed than it is about Brazil or importing clothing from Vietnam, I think. Now, the one thing about trade is obviously the largest trading balance is with China. And Trump obviously wants to address that because he's giving China a lot of US dollars. And as you all have seen, he's quite antagonistic towards China. So in the context of that, and at the risk of just rambling along here, I think the ultimate thing that we would want to see to set a bottom here is either the Fed blinking, which will materially, allow Trump to raise more funds, or conversely, some sort of agreement of some nature with China, which may or may not include forcing China to finance the U.S. government by buying treasuries. Forcing is not a word that happens in governments, but some mechanism where this trade surplus that China has almost directly goes to finance the U.S. government by a purchase of treasuries.
I think that's probably a bit of a it's a bit of a unique take, but as far as objective goes, but I think one of the things we need to be cognizant of is what, as you said, what changes the direction, what sets an understanding, right? So it's that deal with China of some description, right? Which, with tariffs, I think both China and the U.S. have escalated tariffs at least once since since Liberation Day already. So that doesn't seem like it's in the near future. If you listen to Jerome Powell's comments on Friday, he was definitely he doesn't seem to be in a big rush to bail out the government or bail out Trump on this and cut rates. So be very surprised if they blink in May. But we also have a lot of, data to come, right? And what's gonna tell us that we're heading in that direction of a recession, and that might cause the Fed to blink, which probably, of the two things, the deal with China or the Fed blinking, I think the Fed blinking and cutting rates is probably the more likely of the two outcomes. What I think is what we're going to pay attention to is, we're going to come into Q1 earnings here for global companies over the next 3 to 4 weeks, probably starting in a week or two. I think that's actually a real That's going to be a real key. I don't expect the Q1 earnings themselves to be material or to be the thing that moves the needle. It's what all these companies are going to say on outlook, right? What is Nike going to say on outlook? I mean, they manufacture most of their goods in Vietnam. What is Apple going to say on outlook with a significant, who has a significant Chinese exposure? I think that's going to be a key part of this, and I think that's what's going to drive sort of the next leg in general markets, and then probably that leans back into driving the next leg in broader markets or in the resource markets.
I guess the answer is nobody knows how this is going to play out. I don't think the U.S. administration knows how this is going to play out. You've obviously seen Peter Navarro saying some things and Elon Musk saying the exact opposite. So I think there's serious disagreement within the administration as to how this should proceed. But going back to the views that I've always expressed about Donald Trump is he likes to do a deal and present it as a win. That's ultimately his career as a businessman, was always agreeing on something and making sure that, at least in appearance, makes it look like he's won. So maybe this is where we are now, and we just need to wait and see how some of these things play out and how he can present them to the U.S. electorate as wins. And then maybe things just stabilize at some rate. Today it doesn't look like it. You said at least one escalation. The U.S. and China have now done 2 rounds of escalations each against each other on tariffs. And, who knows where that goes? It's difficult to say. In terms of just more broadly, and I don't think anybody will be surprised, tariffs are tremendously negative for global growth, period. We've seen crude oil and copper and pretty much all the industrial metals and commodities taking out the chin over the last couple of days. Obviously anticipating weakness across the globe in the economies and potentially global recessions. The data today doesn't seem to show that we're there yet, but certainly that would be the direction that we'll start trending with the winds that are blowing today. Gold has been so far a nice outlier. It's certainly up the highs, but very, very little naturally. And fortunately, we've been well positioned in the gold space, and we've been able to, gold stocks have underperformed the commodity, but generally in the context of other equities, they have performed better.
Yeah, and I guess the as we get to how we're positioning and what we're trying to do here is that you're coming into historically out of these liquidity drawdowns, what rallies first and rallies hard is gold, and then gold equities that go with it. And if you look at March 2020, that was gold. You go back to and you can go back and look at them generally, and that's what you see. You see these good moves in gold, and then follow through in gold equities. In particular, conversations we've been having over the last 4 or 5 days is, your large liquid gold names have not their businesses didn't get worse, right? Gold, the 2 days that gold spent below 3,000 didn't make Agnico Eagle less profitable. That's part of that process. And so, for us, there's sort of been, we're well positioned in gold, but we're working to increase that exposure. And we're going in the easy route on that exposure, which is to go, adding exposure into our larger, more liquid names. And we don't own Agnico right now, but it's certainly a name that it's the best and largest gold producer out there now by market cap. And so it's certainly one where, it's going to attract capital from generalists if generalists take a shot at gold. Yeah.
So, I mean, the way I see this happening is, in the downdraft, everything goes down, including gold equities and the likes. Then there's the first rotation is into the safe havens, which obviously gold has that characteristic, and gold equities after that. And that's the place to be during the volatility and before you have any evidence of any type of bottoming or any type of solution inside, which would be, like we said, something around the Fed or some trade agreement with China that involves some monetary aspect. But after that, once the floors set in and things start rallying, some of the biggest concerns about the global economy will start to subside, and those more industrial parts of the commodity complex will rally then. So that's the way I see it playing out. Gold's the place to be right now, but at some point, which, to be honest, could be today or could be a year from today. Who knows? It's very hard to tell. A bottom is going to be set in, and much like 2020, Freeport bottomed at $4, and a year later was $40. Once the risk of this volatility and the global recession subsides, the industrial commodities that have underperformed and their equities that have underperformed will rally back. So I guess, and to validate what Derek said, right now we want to remain liquid, and we want to remain in the sector of the market that we think has the least amount of risk relative to this, frankly, political rather than economic uncertainty.
Well, I think the risk is, and the political uncertainty is going to will create economic uncertainty, unfortunately. But I think that and that's a great point, right? When things are bleak and the large industrial, I can remember tech being at $4 in 2008, right? If you bought tech then, you would have done okay. I think it went to 40 again, so similar to the Freeport trajectory. And so I think that's a really valid point. It's easy to say, oh, now's a great opportunity to step in and buy stocks. But the reality is that, like most people, we're mostly deployed, right? So when something like this happens, we've got a little bit of protection on the liquid side, and we can move things around. We've got a little bit of cash, but we're not, as a percentage basis, we're mostly invested, as are most people. And so then it becomes.
I'm sorry to interrupt you. Frankly, that's by design, and the structure of our vehicle, which effectively does not have a redemption mechanism, allows us to weather out the bad part of the cycle this way, without having to be forced to sell some of the stocks that we believe in and we have great conviction in, and where we see this is only just a temporary blip in valuation as a result of this political exogenous event.
That's a great point, Sam. We're not a traditional fund, like Sam was talking about earlier in the episode, right? We're not. When we were having conversations on Thursday and Friday, we were figuring out how much cash we had to redeploy to take advantage of some of these dislocations, and then how we wanted to maybe alter the portfolio, not figuring out how to fund redemptions. And so that should, our expectation is that benefits our shareholders. But kind of what looking ahead at this market, right? If you were, I guess there's as you say, okay, now's the time. There's a buying opportunity, and it may get more attractive from here if fears of a recession get locked in and markets go down further. I mean, as we're speaking right now, the S&P 500 is up today after China announced reciprocal tariffs. Gold is actually doing really well, back above 3,100. But I guess there's two things, right? So we're looking at redeploying on the liquid side, and that's because we want to be flexible. That we think gold stocks are going to do well and rally off this bottom or off this pullback. The other thing is that we think that gold, we want to be able to, on the liquid side of our portfolio, which is about 30% of our assets, we're able to quickly reposition for those more industrial commodities like copper, when the bottom actually goes in and sort of the market starts to price in the growth versus a pullback or a recession. I think the other thing though is that, and something that we look at a lot is, there's all kinds of names that we follow that we like that maybe we missed or we didn't buy enough initially. That's also something to think about as you look, right? Is like, hey, there's that gold name that I really like. That might be something that it pulled back. And so this might be an opportunity to step in and buy some there.
One thing that I want to add is that this type of events don't materially alter the long-term projections for commodities. I think it's pretty well accepted that the coming copper deficit over the next 2 decades is going to be quite immense. The number of copper uses keeps increasing, and the intensity per use also keeps increasing. So, this is on the fringes of reallocation of where the copper may be coming from for certain uses, rather than the absolute idea that we are facing a significant copper deficit over the next 2 decades. So, don't allow the short-term events take that the long-term views away from you. So, one of the things that we're quite curious about is what's happening to copper majors and copper development projects in this period, to perhaps see if there's an opportunity for us to participate or get involved in a story that perhaps we've liked for some time, but we haven't seen the window to get in and participate. And I think that's the key part of investing, is you have to dissociate the decision of liking something and the moment when you decide to invest. They don't need to happen at the same time. You can like the project, you can like the company, and you can just sit back and wait till the window of opportunity to get invested into the story arrives. And those, happen occasionally, but typically when there are short-term crises like this one, those windows open and allow you to get involved.
If it is a short-term crisis, I think is probably a good caveat as far as. But I think the other thing that you need to be very, very cognizant of, and investors do, is you start to look at, you're not, if you're buying an eco yield, you don't have to worry about balance sheet risk, or Anglo American or K92 those are things that we own. But if you're going to go into a development stage name, or an exploration stage name that you really like, and you're like, you know what, you never saw an opportunity because the stock was running, it's pulled back, you're like, oh, there's an opportunity to enter. Before you pull the trigger, I would make sure that you do some work on the balance sheet of that company. Make sure that they're well funded. A development name that we own and I'm a director of is OMI. It's had a pullback. Potentially, if it's a name you've been looking at, could be a buying opportunity. Certainly not investment advice, but I look at that name and we've just completed that OMI had just completed a significant financing, and so was well funded. They don't need to come to market in the next 3 to 6 months, and I think that is a very, very key thing in these moments of volatility. Attracting new capital or attracting capital to fund an exploration and development stage company can be very difficult. And so it's something to be very, very cautious of in this market, is that if that developer exploration company that you're sitting on needs to come to market, might be an opportunity you might want to think about holding on to that through the cycle, because it can create additional challenges.
On a more philosophical sense, and my view, and this is part of the reason why we have a vehicle that's closed-ended in the regard of not offering redemptions, is that nobody really knows. Timing is the hardest thing to identify in markets. Nobody knows when the bottom is in. So we like to be pretty well invested, not fully invested at all times, but pretty well invested. So if anything, if you're considering based on this risk to liquidate your holdings, my view is that you just rotate into different types of risk, like we're doing, into more of the liquid gold names as a place to sit until we have evidence of a bottom, confirmed evidence of a bottom, not suspected evidence of a bottom. That's a very dangerous place to play, buying things as you think they're going to rebound. You first have to see the rebound, and you buy on the way up. So we like to be pretty well invested, and I think that's the best way to do it, because once the rebound happens, things tend to rebound aggressively, and they won't really give you enough time to get back into them, and you may miss like 2020 and like 2009, you may miss this completely crazy rallies that happen after these volatile events.
It's a great point. And if you look at basically since 2008, anytime there's been a liquidity drawdown, the rallies are very sharp, right?
Yep.
Like this. And it's because the Fed's has been much more interventionist than it had been historically. Rather than letting the economy play itself out, they would step in and react sooner. And so I think that that aspect of it is something you got to watch. If you fully exiting a position, you might look back and go, you might find a more attractive entry opportunity on that position if you exit, which is not a path that we're taking in any of our positions. But you might find a more attractive entry point to get back in. But the reality is that you might miss it too, and you might go, oh, I sold it at I sold the stock at 40. The stock went down to 35, but I didn't think the bottom was in, so I didn't buy. And then the stock's 50 when you try to go buy that position back. And we've seen that lots of times as well. But we've watched stocks do that and go, oh, but those are the names on our watch list that we look at and go, okay, oh, the next time that one pulls back, we'll look at it again, right? Comes back to a level that we think we think makes sense.
Yeah, no, with the other one is with your core holdings. Unless there are some liquidity concerns within the story, debt or lack of cash, etc. If you have conviction on a name, and you liked it at say 40 cents and now it's 30, how on earth are you considering selling it? You should be considering finding other sources of capital so that you can buy more rather than selling it. And we
strongly advise against leverage.
That's to say that our core holdings on moments like this are not effectively not for sale. Once you identify these great stories that you want to get behind, this volatile episode should be opportunities to buy if they go lower, but never to sell, frankly.
If anything, it kind of is, as you said, earlier, right? Probably some of our lower conviction names, were probably those ones are more likely to get where we would trim, and we would be buying on the high conviction names. And you're absolutely right, especially for gold names, right? Because unless it has a liquidity, like a cash concern or a balance sheet concern, your gold name didn't get any less. The fundamentals of that gold name didn't change. Gold's still north of $3,000 an ounce, so you still have that development forever. Now the cost of capital has changed a little bit because the risk profile and the volatility of the market has changed, but the reality is those fundamentals haven't materially changed. And so even at a slightly lower, if the prices pull back 25%, it should be something you're looking at adding to. We may be doing that as we certainly will be looking at that as well. But liquidity is a premium as well in this market. So position trading liquidity, I guess, as opposed to balance sheet liquidity. Well, both do, I guess. It's kind of
I'm looking forward to the moment when this episode actually comes out to the public and I can watch it and then see how much the world's changed.
Yeah,
between this moment and then.
Yeah, 3 days from now, right?
The guys at Crux are excellent at turning this around quickly, but the pace at which things are moving, it's unreal.
Yeah, the world's changing so fast, and I think that's the key. But I think I guess probably if you had a concluding sentence right from this episode is that we think that this market volatility and what's happened, it's turned markets upside down and it's created a lot of trading and there's been this race to liquidity, but particularly in gold names, it's created, for gold equities, it's actually created a bit of an entry point because gold hasn't gone down. And so if you have conviction, names that we have conviction on, liquid and illiquid, or fundamental, as we describe it in our portfolio, those are places, if you are selling something in your portfolio, that's where we should be adding, and be very careful about getting out of the market. I think just because there's a little bit of volatility and risk, because that is what you'll regret in the end, because this too shall pass, and it may go lower from here and it may be painful, but this too shall pass. And so I think that's probably the concluding sentence. Of course, by the time this comes out and the Dow's 10% lower, everyone will wonder why. What I'm talking about. But anyways, it is what it is. So thank you everyone for your time today, and always appreciate your feedback on what we're doing. And we'll try and be back next week to see how much markets have moved since
Pick up
since the last time we spoke. Yeah.
All right. Thank you.